Soft Currency Economics by Warren Mosler. Open Market Operations: How the Fed Provides Reserves to the Banking System. There are two ways by which the Fed can provide additional reserves to the banking system. One, it can make loans to the bank through the discount window. Or two, it can purchase government securities. Suppose the Fed makes a $100 discount loan to the First National Bank. Once the Fed makes the loan, it immediately credits the proceeds from the loan to the account of the First National Bank at the Fed. The bank's reserves rise by $100, while its borrowings from the Fed have increased by $100. When the Fed buys securities, it increases reserves. Suppose the Fed buys $100 worth of bonds from the First National Bank and pays for them with a check written on the New York Federal Reserve Bank. The First National Bank then deposits the check with the Fed, and it is credited to the First National Bank's reserve account. The net result of the open market operation on the First National Bank's balance sheet is that it reduces its holdings of securities by $100, while it has gained $100 in reserves. If the Fed wishes to decrease reserves, that is, drain excess reserves, it sells government securities. When the Fed sells $100 of bonds to a bank or the non-bank public, reserves decline by $100. For example, if the Fed sells a bond to an individual, the check the individual writes to the Fed reduces the deposits in his bank by $100, which reduces the bank's reserves by $100. The individual adds $100 in government securities to his assets and subtracts $100 in deposits. The banking system loses $100 of reserves.